Guys, credit does not exist so that you can flex. It doesn't exist so you can buy nicer stuff. Credit exists to decide who gets access to leverage and how expensive that access is going to be. People with strong credit don't just simply buy more things, right? But the key is this: they get access to assets earlier, and they get access to those assets at a cheaper cost. I'm talking about real estate, business lines of credit, equipment, and other cash flowing opportunities. Your credit determines what lane you're allowed to play in. It's going to be the 500 credit score lane, the 600 credit score lane, or the 700 plus credit score lane. And not all the lanes get the same opportunities. So this isn't random. It isn't luck. It's patterns. Let's keep in mind that your credit score is not a judgment of your character. It's not a reward for your effort. Your credit score is simply a summary of your behaviors to date. That's all. Think of it like a receipt, right? Every payment, every balance, every application, all recorded, all categorized, all measured over time. So if your credit isn't where you want it to be right now, the solution's not tricks, right? The fix is simply changing and correcting the things that the system is measuring. And here's why all this matters. Only a small slice of people ever end up in the lower credit lanes, believe it or not. A much larger portion of the country sits in the 700 plus range, where borrowing is cheaper and access is easier. Guys, the average FICO score in the US right now is about 715. That tells you something really important. This is not about luck. It's not about income. It's about repeatable behaviors over time. Credit outcomes, they just follow patterns, and patterns can be changed by each one of us. So here's the chain that most people never see, okay? Your daily money behaviors create your credit profile. Your daily money habits determine your cost of capital. Your money behaviors and money habits, that's what determines your access to appreciating assets. That's the game. It's all about patterns. Guys, let me know in the comments below if you've actually fixed your credit or raised your credit score. Let me know how in the comments below. Now, let's get specific, okay? There are 3 credit bureaus that track behavior: Experian, Equifax, and TransUnion. They collect raw data. Scoring models summarize that data. Now, what does all that mean? It means you don't have one credit score, right? You have multiple measurements of the same behaviors of yours. So let's be real about this thing. Fixing errors on your credit report is not optional if you're serious about improving your credit. So before you optimize your behavior, the very first thing you want to do if you want to improve your credit score is you have to verify the accuracy of the information that these credit companies actually have. Because honestly, guys, errors are common when it comes to your credit report. Old collections that should have fallen off, but they didn't fall off. Incorrect late payments that weren't really late, but got reported as late. Balances that are not even yours. That happens sometimes. Or accounts that get reported twice. So if the data is wrong, your score is going to be wrong. A recent survey found that 44% of participants identified at least one error in their credit report, while roughly 1 in 5 Americans, about 20%, they have a serious error that could negatively impact their credit score. That's important. So one wrong line item can suppress your score for years. You want to make sure you do these things, okay? Pull all 3 of your credit reports from all 3 companies and compare them line by line. Dispute any inaccuracies that you see directly with Experian, Equifax, or TransUnion. You don't rebuild on bad data. That's key. So once your credit report is clean and you've made sure that it's accurate, then you can work on your behaviors that really matter, okay? So what behaviors actually matter the most in terms of what we can do? First things first, most people think paying on time is actually winning in terms of credit. It's not really winning, guys. You got to think about it like this. On-time payments are really just a neutral look on your credit report. I mean, paying on time is important, but what matters is when balances are reported, not just when the bills are due. For example, every credit card has a statement date where balances get reported, and they also have a due date where payment is actually required. If your balance is high on the statement date, that's what gets reported, even if you pay it off later, right? Here's the smart thing to do when we're talking about paying things off. Pay before the statement closes. not just before the due date. Okay. People get obsessed with due dates being already behind, right? Guys, let me pause right here. If you're trying to build or rebuild your credit, you already know this isn't about flexing or buying stuff. Credit determines what lane you're allowed to play in when it comes to assets like homes, real estate, business opportunities, all of that. That's why I want to tell you about Kickoff. Kickoff is a credit building tool designed to help you build credit safely and easily. There's no credit check to apply, no interest, and no hidden fees. You sign up in just minutes, choose an affordable monthly plan starting at $5, and you build credit by doing one simple thing: making on-time payments. Now, those on-time payments are automatically reported to all three credit bureaus, helping strengthen key credit factors like your payment history and utilization. Kickoff users with credit under 600 that made on-time payments increase their credit by an average of 25 points in just their first month and up to 86 points after their first year. And right now, Kickoff is giving my audience 80% off your first month. That's as low as $1 to get started. Click on the link in the description box below. If your credit is holding you back, this is a simple, structured way to start moving forward. But here's another one. Another behavior that you can affect is utilization. This is where most people sort of lose or don't quite understand it. Utilization is how much of your available credit that you're actually using. Same debt, different signal. Okay. High utilization rates for most of us is stress on us, and it's stress on our credit score. Low utilization rates is more control, and it looks better on our credit report. Credit models prefer under 30% utilization. Ideally, they want under 10% utilization, right? That alone can move your credit score dramatically if you understand how to get your utilization down to, say, 10%. And it's calculated across all of your credit lines, which is why credit limits matter. And it's why statement timing matters even more. Now, the third behavior that you can engage in to help your credit is fewer applications. Every time you fill out an application, it sends a signal to Experian or TransUnion or Equifax. Too many signals equals a risk. Strong credit looks boring, guys, okay? So in other words, space your applications out. Apply for credit with intention, right? Stop the impulse credit shopping. In other words, stop filling out a credit app for a 10% discount when you get to the register at whatever store you shop at, right? Patience will help you build leverage in this credit game. So you don't want to have too many applications in a short period of time. The fourth behavior that you can do is mix your credit with intention. There's two main types of credit, guys. There's revolving credit. That's your credit cards, your lines of credit, and they have flexible balances that change month to month. The other type is installment credit. That's your mortgages, your student loans or auto loans, right? These are your fixed payments over time. So this doesn't mean go out and get more debt. That's not what I'm saying. It just means your credit profile, if you want to raise your credit score, should show structured responsibility that is a mix of different installment payments and revolving credit. Now, do you need to go out and get more credit so you can have some revolving credit on top of your installments? No, I'm not saying that. Does it help your credit? Yes. Do you need it? Not necessarily. Now, the fifth behavior is this. The fifth thing you can do is just be boring, because boring is consistency. Credit rewards adults who remove emotion from their purchases. That means auto pay, calendar reminders, do your own monthly reviews of your credit if you can, right? Credit is not built by being obsessive. It's just simply built a lot of times by boring consistency. Now, why all this stuff matters? Here's the part that a lot of people miss. Two people can look at the same asset and live in completely different financial realities. Lower credit usually means high interest rates for you, worse terms, less cash flow, right? Whereas stronger credit, looking at the exact same asset, will usually mean, when trying to buy that asset, lower cost of the capital and lower interest rates to buy that piece of capital, and better terms and more leverage for you and more margin for you. That's why strong credit matters, okay? Credit doesn't make you wealthy, right? Let's get that out of your head. Credit just simply determines how expensive and how long your path to wealth is going to be. Now, the goal isn't a number, right? I want to get my credit to 750, 720, 820. The goal is not the number. The goal is access. You want to have access to assets. You want to have access to leverage, right? You want to have access to the opportunities that gives you appreciation on whatever you have, because the goal is to buy appreciating assets that are going up in value, right? Don't chase points. Don't chase good credit just to buy stuff. Instead, you want to fix your behaviors, because people who win with credit, they don't use it to buy just random stuff. They use it to build wealth through these appreciating assets that oftentimes require you to have better credit. Guys, don't forget to click the kickoff link in the description box below. If this video was helpful, do me a favor, drop a comment below letting me know that it was helpful, and share this video with your network of good people. Remember, the best person to take care of the old you is the young you. Until the next video, peace.